The market's being driven by a lot of fundamental growth factors. Certainly, we see that the economy is still doing very well. Forward earnings are actually making so the market is priced at a very reasonable rate right now. However, I think that right now there's also a lot of volatility. I mean, we've seen in the past few months how the rally of 2017 has kind of like stalled. A protectionist policy regimen would definitely hurt a lot of company earnings and revenues across the board. It will certainly raise costs for a variety of companies. We see how in the tariffs with China, with the solar panels, with steel, how each time tariffs have been announced or discussed, the market has crashed by 1 or 2% even on some of those days. And so I think the renewed fear of tariffs is what's right now really keeping the market down. And so I think it's going to be a tug of war essentially this upcoming year between the market's fundamental growth factors and this worry about the possibility of protectionism being implemented. Probably having more diversifying worldwide right now would be a good strategy. I think we see with like a Eurozone policy, US policy, Latin America, Asia, et cetera, that a lot of countries are beginning to, and so the past few years, a lot of countries kind of have like risen together, and so the world has been very kind of like smoothed over. There has been many different trade policies, differing monetary policies. I think now we're beginning to see some more divergence, and so this offers both the risk of certain countries being more volatile, as well as offers the opportunity to finally diversify in a much stronger sense for investors. And so I think looking at Europe, looking at Asia, and emerging markets, and I mean, I know right now India is a big rising place as well in terms of the public equity markets, and so I think trying to find new opportunities to reduce volatility given the current the policy risks involved for U.S. markets.